This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this morning Andrew Joseph, who is no stranger to our Trigger webzine subscribers and our twice-weekly technical market alert updates. Andrew is principal of Golden Phi, publisher of Trigger's Media Publications, Inc., and editor of the Trigger's webzine and website. Good morning, Andrew, and welcome to Macro Analytics and our third session on this month's analytic discussions.
Hi, Gordon. It's great to be back. Thank you for having me.
I have mentioned this in prior sessions, but for those that may have missed them, I had asked Andrew to join me on Macro Analytics in 2012 for basically three reasons. One, he's an excellent market technician, and in my mind, clearly one of the rising stars in the field. Two, he has a solid grasp of not just classical technical analysis, but additionally many of the new emerging areas less understood by mainstream technicians that I believe will begin to come out this morning in some of the charts that he's brought with him. Three, his ability to distill the tremendous amount of content we produce at Gordon T. Long into a very concise, crisp, and practical format for swing and day traders. The graphic you see on your screen now shows the overall filtering and analysis process we go through at Gordon T. Long, which culminates in for traders in the Triggers service. In our last session, we went through our drivers from a macro viewpoint and summarized the feedback we got from this month's macro experts in the chart that I'm showing here on the screen now. Andrew, you've brought some great slides with you this morning that take these drivers and others that we don't have up here, from the MATA and the GMT service analysis, and show us where we currently stand and some of the things that the Triggers subscribers are now seeing.
Sure. Thank you, Gordon. This image is actually from an old update format, and it is the update we gave for the SPX at the beginning of May. I believe that's May 1st. Our thinking at the time was that we were in a consolidation move, and we are looking at the gray zone and ultimately the red as our next targets. The support we have had since October of 2011, which is shown by the heavy blue dashed line, would be broken, and the market was long overdue for a correction. This post was for our members as of May 13th, and you can see that we have listed the current market driver for the SPX as well as the nearby technical triggers. We also show an indication of what the current trend is and our targets for it. As of this update, we had hit the gray zone and as expected, and we were watching for a potential pullback before we moved down again to the red target of 13.10.
That was on May the 13th that you were calling that 13.10. Well, actually May 1st.
Yeah, well, that's when we gave it to our Trigger subscribers, yes.
And I say because we went with 1300 in, I guess, the March version of our MATA document, so that from an intermediate term, we were already seeing that, but even though at a short term it wasn't as clear in the chart, was it?
No, but we were slowly working our way there. But we definitely had an idea for. Actually, I think even back in February, you had that number listed as to something to look towards as to where we may be heading.
Yeah, exactly. And I'll make a comment a little later about why we were so clear and knew that, and why we could see that from a macro standpoint for many reasons, but. A lot of them weren't just technical and fundamental, such as we knew it had to have a 38.2% retracement, but in fact, risk and yield spreads were telling us why that number. Sorry to interrupt, Andrew.
No, thank you, Gordon, and thank you for explaining that. Moving on to the next slide, it shows us the new and improved and recently upgraded inter-issue updates that our subscribers are now getting. Shown here is an image of the daily technical analysis provided for the SPX in our update on May 17th. At the top, we can see listed again the current drivers and the triggers for the market. We also see the direction of the trend and the targets listed for the market. With the chart itself, we can see that at this time it has broken through the channel support and our gray target zone and was heading for the next target level. We also caution of a potential for a pullback to be wary of, a possible retest of the channel we had just broken. And that this would also be dependent on what would happen with the US dollar at the time, as it appeared to be reaching resistance. We have listed at the top of the chart in the current driver for the SPX. On the last slide of the S&P is showing what actually happened. We showed you at the start back in May 1st we were looking for this target, and there we go. And Gordon, as we were talking, you were calling this for back in March with your MATA document.
Absolutely, Andrew. And as I said, the issue was risk. And the risk we saw was in the divergence and dramatic divergence between yields in the bond market and the yields on forward earnings on stock yields. There was a lot of feelings in the market that interest rates would go up on the yields and that stocks would come down. And based on all the work we had done, Andrew, with financial repression, and we had called for around the top, what was becoming very, very clear to us back then was in fact that the yields would not go up. That in fact yields would fall even from the 2% in the 10-year, and people thought we're absolutely crazy. They couldn't go much lower than the 2% or 1.8%. And as of this morning, we're down at 1.65, 1.66, which is the lowest interest rates, Andrew, in 120 years. We've never been this low. So we sounded like heresy, but we felt it would fall. And stock market would stay elevated for a longer period of time. And there's a reasons for why the Fed wants this. This is an orchestrated, well-executed strategy. And then, in fact, stocks would come down as they are right now. And we felt that they would take us into this range to be able to give, and we've talked about this in the previous session, cover for the central banks then to go with the next round of reflation trade. And this leads into the charts I think you have next on gold, Andrew, because gold is broken down. But in fact, if they start this reflation trade, it'll change the whole parameters of gold, which is what the Fed wants, not gold going up. They want to break down the concerns with inflation to give them the cover. And this was very, very clear in all of the charts that we had from a yield standpoint. And if you had been paying attention to the drivers, there was actually a 2-week window in here where you could position yourself and take full advantage of it. And this is this is why you have to watch drivers consistently. Sorry to go on there, Andrew, but sure. I just thought it was important that everybody understand. I often talk about nominal and real, and you just went through the S&P in a nominal perspective. But you have to understand it in a real perspective and value of money, as you'll see in gold. But what's driving each of those? And it's not as simple as currency. Gold right now is trading against currency, the U.S. dollar strengthening, and the market's falling based on the U.S. dollar, in fact, strengthening.
Sure, but that's going to change.
It's actually changing as we're talking.
For sure.
And the correlation is there, but then you have to understand what's behind that correlation. And it eventually leads back to the yen, and it then moves back to the commodities complex right now of what's happening right across the commodity complex. But unless you've got your hands on each and every one of these and understand where the pivots are, where the support, where the resistance are, where the high volumes are moving. I've often said, Andrew, as you well know, the equity markets are nothing more than the tail on the end of the dog.
Sure.
The 800-pound gorilla is the bond market, but I can tell you this, the 10,000-pound elephant is in the swaps market, and that's where the game is being played right now as we talk.
And from a technical level, as you just mentioned, Gordon, what's really interesting is when you start looking at all these markets and how they're behaving together, they all seem to come to points and heads at the same time. All of them come to the same technical area that it's going to be a breakout, all of them at the same instant.
That's not a coincidence.
It's amazing. And when you see that, then you know that the timing is that something is going to happen one way or another, because all the charts are saying this is what's going to happen.
Think of it this way. Think of it this way, Andrew. All these computers have been programmed separately, but they've all been programmed with some common themes and understandings and premises. And they all also have certain relationships. And so, though there seems to be a lot of chaos, they will zero in like a magnet will to a piece of metal. They'll come close right in on it. It may not be totally precise, but it becomes very, very close. And when you're watching the charts as close as you do and I do, these things become very, very clear. And,
Sure.
but then often becomes, well, which way is it going to go from there? You know, it's coming to an inflection point. And the only way you can typically find which way it'll go is you've got to come down from the macro. You can't come up from the momentum or the trading level.
For sure.
I interrupted you before you were going to gold there, Andrew.
That was great. Thank you, Gordon. This is the market at the present time, and we need to wait and see what we're going to do from here as we're recording this session. You can see right now our zone has we have a cluster of Fibonacci retracement levels, and most especially the highlighted in dark blue, the 38.2 retrace from our latest rise since October of 2011. So we would expect the market to at least pause somewhere around here at the very least. Moving on to see what we're looking at for gold. This chart gives us an interesting analysis using Fibonacci circles and time zone. I was able to frame the market fairly well. We had just come from a time zone suggesting we would have a move soon. We were looking at a continuation of the trend down, and the Fib circles provided us with some potential levels to be aware of. Our next image shows us the updates for the gold on the weekend of May 13th that we had put up on the website for our subscribers. It shows our weekly chart has moved as expected, falling off after the time zone and coming down to the next Fibonacci circle, which coincidentally is also lining up with the both lower Bollinger Bands. The next image shows us what we gave to our subscribers as an update on Thursday, March 17th. We had done a little reevaluation at this time and recognized that there is a potential for a level channel to also be in the mix here, and to see how that worked technically with the current consolidation shown more clearly in the hourly chart. Again, we see the market drivers for the gold, triggers, trend direction, and the targets we see coming up. In this update, we were watching the consolidation to see if we had the channel correct, and if so, how high our pullback will go. Various likely targets levels are also shown. Our last target of gold is just an update of where the market currently sitting as of this presentation. It's part of what we are considering for the next weekly update and what we will be posting for our members. There are several things going on that need to be taken into consideration, and we'll be expanding on those for our subscribers.
Andrew, thank you very much for taking us through that. I know we could spend a lot more time this morning on all the other charts that you put out. I encourage our listeners to go to your website, find out more information, sign up for a trial. You can sign up at either my site or at Andrew's, and to take advantage of a chance to really look at this detail. Andrew, in closing, tell listeners how they might find more information about what you do and about triggers in general.
Well, hopefully we've given people a good idea of what we're trying to do here, Gordon. We're just getting started and have only a few spaces left for introductory memberships. We're about 2/3 sold out at the moment. And as we finish off the website and beta testing it, we're going to close those rest of the subscriptions. We're trying to summarize your great work, Gordon, and then bring it down to a level for day-to-day use, including the market drivers for the markets, and show the relationships and how they impact specific markets. As well, we identify the specific technical and economic triggers and targets. And then at the end of every update, we also have a market calendar that not only has the important market information, release time and dates that you could get from Bloomberg or wherever. It also has the important technical timing dates, such as the Bradley model and Fibonacci turn dates, that you're not going to find anywhere else. So again, we can hopefully people will come by at triggers.ca and take a look at some of the things we're doing.
Andrew, we'll wrap here. We're up against our hard line. We're looking forward to having you back again next month, and we'll go through the same kind of charts. I'm hoping that our guests this month will bring some more clear and crisp insights, as they always do. I'm hoping to expand our guests and contributors so that we're really ensuring that we're focusing on the right macro drivers here to get our drivers right. So until then, talk to you later.
Thank you, Gordon.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.